Well there, Canadian wealth seekers. We are digging in here today, and we're actually going to be talking a little bit about heading
Ooh,
south in
it's
this
summer though. It's
episode.
coming.
And
It's
yes,
coming.
it is summer,
Almost
kind of
summer.
odd, right? Kind of
Wait for
odd.
winter.
Now, there's a couple reasons why we thought this might be an interesting episode. And, we've mentioned it on a few earlier episodes. We've been hearing this buzz of, like, especially in the real estate community, real
Right.
estate investment community, in particular in Ontario. With, as many people know, we have some pretty tenant friendly rules when it comes to
Here in
leases
Ontario?
and renting properties here in Ontario, where, you and I, John, are from. We are in the Windsor, Essex area of Ontario, and we have properties here in Windsor, Essex. So we have an Ontario
Mm-hmm.
portfolio, but we also have some little
Mm-hmm. Mm-hmm.
spatterings elsewhere. And more recently, we've actually started looking south ourselves, except on this particular episode, we actually want to take a bit of a high level holistic view as to why looking elsewhere could make sense for investors, whether it's real estate, whether it's
Right.
equities, whether it's any type of investment. And we actually want to do a little bit of a comparison to kind of talk about the pros and the cons, the benefits and the risks that might be associated with doing so, and just to give people a sense as to where they might want to go. Because
Mm-hmm.
the problem is, we as humans, we tend to follow
Right.
the herd, right? So when you hear a lot of people are, there's even some out there, friends of ours, colleagues of ours that are,
Right.
selling their portfolios in Ontario and they're taking it all down south, or at least that's sort of the
Yeah.
message that, a lot of us are hearing. And, today we want to just take sort of a balanced approach here, give you some perspectives and help you to think through your own situation to try to figure out what the heck is going on. And should I be hopping on that
Right.
train or on that bandwagon? Or is there a different way? Like, maybe it's perfect for me. Maybe it's a horrible idea for me. That's going to be the goal here in this particular
Yeah, and I
episode.
think there's lots of us wondering too about this kind of like let's pack up, and why would we want to invest in Canada right now? We've had multiple people reach out to us after, the 2024 budget coming out and saying, we are adjusting the capital gains tax for for individuals on any gains over $250,000. We're all of a sudden moving it from 50% to 66.7, or two-thirds of that. And we've had people reach out to us to say, why would I now want to invest anything in Canada? Should we just move everything to a different
Mm-hmm.
country? Should we move to the States? Is this the time? And so, you're going to be hearing, and maybe you're listening to other podcasts, maybe you're listening to other people on any social media, and they're saying the same thing. It's like, we're moving south, where we have to, we can't keep investing here because we're going to lose, on the tax situation. And, I think it seems natural to kind of go, should we go that route? And kind of figure out whether buying in the States or buying in another country makes sense right now. But I'm going to tell you right now, like, the reason, like, we are doing this episode not because specifically of the capital gains tax, but there are other reasons that have made it maybe more attractive to look elsewhere in Canada, and kind of like explore a little bit, and figure out what is the right move for you. And that's what we want to do here today, is to help you kind of decide, should I just abandon ship and move everything to
Hmm.
the south? Or are there some gains on staying here versus going there? And what I should think about in terms of, in general, my portfolio, whether it's in real estate investment or any other sort of asset class. Because, Kyle, I think
Hmm.
the wonder is, like, if I go to the States and buy there, I get to, like, walk away from the capital gains tax. It's like, I don't have to worry about that
Right.
anymore. And you're like, are you sure you really know what you're talking about?
Yeah, yeah, exactly. I have a lot of these calls with many folks, some from the community here, others just through other sources that, we're hopping on calls. We're doing a lot of times it's corporate wealth management sort of discussions. And, the question often comes, and one in particular, one colleague, I think, John, who I'm talking about when I say this person's, out there and quite vocal on social media about how they want to just like leave Canada. And, they've got quite a few assets. And, we've chatted about this at length. And, whether it's the Bahamas or whether it's, to Turks and Caicos or wherever you're going to go, the problem is that if you already have assets here in Canada, we've designed this. I say we, like I did it, but, we've designed this as a country, or at least the leaders of our country, so that it makes it hard for you to do it. Like it makes it hard for you to leave. Now, if you're the person who wants to leave and they want to get to like a 0% sort of income tax sort of environment, like the Bahamas are, or, some of these other places, you are going to get kicked in the butt on the way out the door. Like, now, mind you, if you're listening to this podcast, I doubt this is you, friends, but if you're listening to this podcast, you have no assets. Like you have nothing to sell. You have nothing to like, you can cross the border and they ask you like, are you traveling with more than $10,000? You're like, no, I don't have that on me and I'm leaving and I'm never coming back. Like it's easy to leave, right? I mean, you've got a lot of documentation to do. You have all of that stuff. But the reality is the more assets you have now, the more of a difficult time you'll have trying to say fully leave. And, if you go to the US and start investing, but you're still a permanent resident in Canada, you're still going to have the tax rules in Canada to live within. So for those who are like thinking like, oh my gosh, capital gains tax is, it's increasing here in Canada. Like, unless you're willing to hit the full eject button before June 25th this year to take advantage of the 50% inclusion, you are probably going to be taking massive losses. And you're going to have to essentially move, all of those assets out and then actually not be a permanent resident here, like a tax-paying citizen here, right? So, we have to think here when we're planning and when we're thinking about our own situation. A lot of times we talk about it all the time. We're all in or we're all out, right? We're digital people, right? We're 1, 0, we're on, we're off. And this is one of those cases where, sure, I don't like the fact that, the capital gains tax is increasing. What it does is it actually makes the need for more tax planning, right? That's something that a lot of people don't pay any attention to, right? The perfect example is everyone that has these big, massive RSPs and they say that's going to be the last bucket that they plan to touch when they leave their working, years. That's not a good idea. That's a bad tax planning strategy, right? Because a lot of that's probably going to get taxed down the road all at once. Well, the same's true here. Now, that doesn't mean it's not a good idea to diversify, but what we're trying to highlight here is like the why, right? Like, are we going to just like run with everybody and go and put money into the US because of X, Y, or Z? Or is there actually a fundamental logic behind the work that you're going to do? Because for us, John, like if we hit the eject button now and we were to, sell everything we have here and then try to reinvest it all in the US, we are taking a big tax penalty to do so. Not only that, right? Sure, maybe we might save some money on this 50% or 2/3 inclusion rate initially. The challenge is that, as we earn capital gains in the US, there's going to be tax associated with that as well. So the real question is like, is it worth diversifying? I think our general answer is potentially for you. Like, diversification is always good, but the reality is it's not necessarily taking everything and completely moving it. Because let's be honest, that is not what diversification is. Like, that's not the definition. That's called going all in a different place and hoping you were correct.
Yeah. So if let's say, we're not, moving asset choice to the States is going to like all of a sudden relieve me of like this tax implication that I eventually have to pay down the line. Like, then let's get into the weeds on like our decision making, because we started this podcast by saying like we have scatterings of investments across different markets. And we, have some investments in the States. And even though people are saying, let's go do this, and we're saying, well, hold off. Why? Like, make it sure it makes sense for you. Fill the audience, fill the listener in right now, Kyle, and going like, why does it make sense for us to explore that market right now?
For sure. And I also want to like touch on why it doesn't make sense for us to say hit the
Right.
eject button here. And the reality is that depending on your situation, this answer can be very different. So for us, we aren't in a cash flow negative situation here right now. You know, like we've talked about it before. We don't over leverage properties in general. We tend to, you know, have some debt equity in there, and that's like a safety issue for us, so that in, you know, uncertain times like now, a lot of people consider this to be an uncertain time with higher interest rates and, you know, things that most people are not used to seeing, right? Because it's been such a long run since that 2008 sort of, you know, little blip. And ultimately, at the end of the day, it's like we don't have a need to hit the eject button. Now, I want to pretend, John, that we had portfolios in Toronto and we were really, or Vancouver, and we were focusing essentially all of our plan around appreciation,
Mm-hmm.
right? And it was working for a while, but we were doing it either cash flow neutral, but for a lot of people, it could be cash flow
Right.
negative, right? And let's say they're in a position there and they saw some of that growth. For those who saw growth, they're probably like, I'm still okay. But for those who bought in with the anticipation that appreciation was going to lift them, and then they saw the blip in the market, you know, they're now thinking to themselves, like, can I sustain this? So for that person, they may not have, or let's be honest, maybe they shouldn't have made the investment in the first place, but is it time for them to maybe dust themselves off and take the chips elsewhere? Maybe, right? So this is the hardest part about this sort of discussion. But for us, when we look to the States, you know, we have a few different things going on. Now, let's be honest, Windsor, Essex, not exactly, you know, Canada's bright spot. You know, we're going to put it out there. We love the area. We love living here. But I mean, Windsor is not necessarily the first place people are looking in Ontario when they think about, like, you know,
Growth.
investment and growth. However, over the next little while, we actually do have a bit of a
Mm-hmm.
bright spot. Some people are starting to look here. We have the Gordie
Yep.
Howe Bridge being constructed right now. We have
We got a battery
the
battery plant happening.
battery plant happening. You know, lots of money coming in, which obviously, assuming that that plant, you know, is finished and, you know, does employ people. I always worry because this happened in 2008 when Chrysler built a plant over on Central. I don't know if you remember
Mm-hmm.
that, John, and they were done building the building, and then they halted it, and then Chrysler ripped it down. They actually, like, literally ripped the building down. Now it's not as big as the battery plant, and the government stepped up to allow that to not happen in this particular case, which is still
Yes.
worrisome for me as to why the government needed to do that. So that said, Windsor looks fairly good in comparison. But for you and I, John, we have, well, first of all, I started my real estate investing journey in
Mm-hmm.
the US.
Mm-hmm.
So I was very familiar with Florida and Arizona. And we've now sort of shifted towards that as sort of a diversification play, but we also have some other
Yeah.
pieces to the puzzle here. So,
Well,
like, tell me
I
about it,
I
John. Like, when you think about the perspective, what are you
so
liking
I
about the US right now as opposed to
so I don't
maybe
think it's
local
like a
here?
US specific situation. And I know that you've got, I think there is some US specifics, but I think the bigger picture is that we, in our hunt to figure out what asset to purchase with our capital, we like to look for a margin of safety, and we always do. And there are some specifics in the United States that kind of allow us to kind of continually look for that margin of safety. But I think that's really if you kind of zoom out, we're always in search of an asset that can give us that margin, because it allows us to kind of like keep our powder dry, so that we're like, we've got this over here, and we don't just like, our strategy isn't to just go and go, I want to invest in the States. Let me just grab that property. Let me grab that property or grab that property. I think what we want to stress here is that our strategy is always about trying to figure out where's the good deal. Can we make sure that that's got a margin of safety attached to it? And then we will move our capital into that. So it's not specifically a US thing. It's all about figuring out, where can I find that deal and where can I find that margin of safety. Now, when it comes to the US right now, there are some unique situations specifically around real estate and buying real estate and say lender opportunities that allow us to create that margin of safety currently.
Mm.
And that's kind of like where this has been, like a strategy that we're now going down, or we have been going down this kind of route. And well, Kyle's going to share some of those specifics with you, but I think that's really the big picture, is like when you think about when you're investing, like one of the first things we learned, when we were first investing in the stock market, on things like buying individual companies, buying individual stocks, or buying individual equities, and going, Phil Towns' rule of number one was like, you buy it on sale. It's like, let's wait. If this company hits all of these great metrics, and it's a company that about, a company that you want to, own, and you can own for a long time, then when, you keep an eye on it, and when all of a sudden there's a dip in the market or a pullback, that's the time to buy it, because you're buying it on sale and you're creating that margin of safety for yourself. So it's like, that's the strategy that we're always taking, and going like, well, waiting, like this capital's in reserve. We always want to try to like structure our capital to be like, can we have access to capital at any time we need to? Because then we'll move it into this deal that's out there. And so we could buy a deal on say in the stock market, which is an area, a zone, or a
Mm.
market, or an asset class. But we also do that with real estate. And so, Cal, give us some specifics. Like, where are we looking right now to help create that margin of safety in the deal in the States? And what specific do the States have that, say, Canada doesn't have?
Yeah, no, for sure. And I want to elaborate one thing too before we dig in, is like, I also want people to think about, if I move outside of our local market, right? So you and I, John, have lived here. I've lived here since very young, since I was in grade two. You have been, your adult life living in the
Mm-hmm.
area essentially. Same with Matt, right? So Matt
Mm-hmm.
is, born and raised Kingsville boy, right? So we know the area. You have so many advantages when you invest in your local market that you now have to either obtain some other way, right? You either have
Right.
to do it through research, through trust, through someone who's
Right.
there. So when I look at, hey, if I'm going to put in that work or that effort, I look, and I can look out to Alberta, I can look to New Brunswick, I can look all over the place. But the reality is, I'm like, well, if I'm going to do that work, I'm like, why not get this added diversification by looking to the US? Takes us out of the Canadian market completely. So for us, that's great. But this margin of safety you're talking about, there's multiple. Some are actually monetary margins of safety that we're looking at, but then there's also sort of, we'll call it like lifestyle margins of safety. So there's like, folks, if you go all the way back to our early episodes, and I sort of share my initial investment in Florida was specifically not because I thought Florida's market was going to do anything in particular, but because I was like, if it doesn't work, I have a place in Florida, right? Whereas if it doesn't work and I have a place in Wisconsin,
Windsor,
yeah, exactly. Or like,
another
in
place in Windsor.
Detroit, or, wherever, Cleveland, like, and I'm not trying to pick on these other places, but it's like, there's nothing like I'm not planning to ever sort of, holiday there for long periods of time. However, Florida, I went there as a kid the whole time. I'm like, so I see that as an additional added margin of safety. It's like a lifestyle margin of safety. And as business partners, we all look at it as well. And we say, if we buy in maybe nicer neighborhoods than we might when we buy locally, right? Like locally here, we're buying for a very specific reason. When we look outside of Windsor, we actually are kind of looking, and we're willing to actually pay a little bit more on, say, price point in order to get into, say, an area, a market, a neighborhood that we're like, you know what, I'm fine to not maybe cash flow as much, as long as this asset is going to maintain value or grow in value, hopefully, over the longer term, as we just knock down any sort of financing on it. So we've been looking a lot in, Florida, in Texas. We also, John, you and I have been to Houston a number of times. We really like that area. So I'm always looking in, Texas, as well as also as Arizona. I own a property in Arizona currently. And those are three places that we look quite a bit in. Now, we're not telling everybody else to look there. And some people might say, well, wait a second, isn't the property tax expensive in Florida for non-homesteaders? Yep. Yeah. So if you don't like that, if you're looking for max return, then maybe Florida's not a good fit for you. But for us, if the deal is right, we're okay to take on a little bit of that as long as we're getting some of these other boxes checked for us. So we're at this place where we're starting to look and we say, listen, if we can find a property with some easy financing options. Now, I say easy, it's like there's a nuance to it because
Right.
it's actually a lot of learning to be done. But I mean, in a perfect world, hey, you find a seller who has seller financing, right? So meaning they don't have a mortgage on this property and they're willing to actually hold the mortgage for you. That makes things super easy. And if they have flexible terms, right? So if we can put down less and in order to do this, and they hold the mortgage for us. And even if this thing is slightly cash flow negative, okay, I want you to think about this for a second. If I put down, say, 10% compared to, say, 30 or maybe even 35% that a lot of lenders require out of foreign investors, if they're willing to take maybe a 10%, I've got a lot of room there for me to go, you know what? I'm willing to go maybe cash flow negative a little bit here on this property because, and you know me, John, I calculate it and I share it with you and Matt and say, hey, it's going to take us 8 years to get to 30% down with this negative cash flow, meaning like that negative cash flow will only amount to the same amount as 30 or 35% that we'd have to pay now. And it's in 8 years. How do we feel about that? Do we feel good about that? Are we able to float this without the assumption that we're just buying it only for appreciation, but rather as a way to sort of store some of our capital, but not all of our capital? Remember, you said powder dry. I like powder
Right.
dry. Now, it also
Yep.
doesn't mean we're going to buy 400 of these and then have no powder left because we
Right.
need the powder to be able to sustain any sort of rockiness that might happen, right? We need to fix something, capital expenditures. But the other thing that you and I and Matt are looking at quite a bit is we're actually looking at people who might be open to the idea of a subject to existing financing. It's kind of like an assumed mortgage, but it's not assuming the mortgage. They actually keep the mortgage in their name and you make the payments. Now, there's some nuance to it. We're not going to get into it today, but maybe we'll do a whole episode on it if you folks comment, rate and review and say you want to learn more about this idea. We will make an episode. We're just not sure there's that many people out there that are curious about it. If there are, we'll do an episode specifically around it. But ultimately, at the end of the day, the way this works is you can essentially take the existing financing and you work out a deal with the seller so that you can essentially assume the payments, not assume the actual mortgage, and you work out an agreement that way without triggering a due on sale clause, which again, a nuance that, you need to be very, very cautious and aware of as you engage in it. So for us, we look at these properties and we go, does this fit our buy box based on where we are now? And we're in a place now where we're also starting to look at diversity from, hey, when we get to the place where we want to say work less or just head out somewhere for 2-3 weeks, we want to pick up properties that are newer in nicer neighborhoods that maybe we might flip to short-term rentals from a long-term rental and use them primarily as sort of business family sort of properties that we're able to utilize and benefit from later in life.
What I love, and this is for me, this is a secret sauce. What I love, because you are like our chief negotiation officer. Like you're getting in there and you're trying to figure out, what is the right move here. But this is the secret sauce that you as our chief negotiation officer, tend to hold, right to your heart. Like this is like something that you live for and live by, which is you're always going into any sort of deal or negotiation, or exploratory, option with the win-win mentality. It's like, I want to get in here. I'm not getting in here like this is my secret sauce isn't to get in here and get the best deal for me. It's to get the best deal for both, or for everyone. And I think this, this subject to availability that, we've been exploring and making use of is it's an avenue that allows us to apply that secret sauce. Like you have to get in there and talk to the people about what is it that you're really after. Like if you're seller financing, like you said, it's like if I can get you to say 10% is a great down payment, and then I can do some calculations about like how much that's going to be if it's if I have negative cash flow. What you were been really doing, and we've talked about this on previous podcast episode, is your really secret sauce is trying to figure out what is it that you really want.
Mm-hmm.
Like, because it's like, do you want the money and you're going to go buy another property with it? Well, then if that's the case, then we have to like that might not be exactly what we're going to be best for us. But if you are okay with if you were going to take that money and you were going to dump it in, you know, you know, an investment, say on the stock market, you're going to take it and put it in over here, and you're just going to like live off the proceeds. Well, maybe we can talk about what you really need, and then we can negotiate on those terms, because it will be what you want with let's say your capital, and then what we want, and that can then be a win-win for both of us, and we don't have to work with the bank, or we don't have to like
Totally.
go over here. Like that's to me, that's the secret sauce that we want to think about, and not just real estate investing. This is like any sort of, you know, discussions you're having with anyone, is to go into those situations and go, what is it that you're really looking for, or what's a hold up here, like what's a
Mm-hmm.
barrier for you in this project, or this idea, or this next move, or this sale, or this I'm buying a company, or I'm selling a company. It's what is it that we really want this other person to like, what they're really after. And sometimes people hold their cards, tight, and they don't want to share that, but it's like you have a really secret saucy way to get people to kind of share that. And then when they do share it, that's when the real power of like, the deal can come through. So when you're thinking about it, we're talking a lot about buying in the United States, real estate. But if you zoom out, there's a lot of principles here that we're talking about
Mm-hmm.
that apply everywhere.
100%, and something that I think is important for people to consider as well, which never comes up, it seems anyway. And what I see is this idea of currency risk, right? Like right now, it's about what, 136 Canadian, a dollar 36 for a dollar US currently. And that's fairly high, relative to where we've been in the past decade, right? So in the past decade, now, mind you, if you go all the way back to when I bought my first property, I bought when the Canadian dollar was actually about a penny or two higher than the US dollar. So, did I know that things were going to work out the way they did? Well, no, but I did feel like the US is the favor, and of course that currency went down. Their currency went down after the financial, meltdown, right? In 2008. So, we had a little bit of an advantage there where with the currency risk we took on, we actually won in that game. Right now at 136 or 137, it's anybody's guess where we go next. Some might predict that we're actually going back to 150, which we were at, prior to the financial crisis and, for some years. Some people believe like we're going back there. If that's the case, then that's kind of an added win. Now, for you and I, we have sort of a bit of protection already. So, like, imagine this: if you hit the eject button in Canada and then you convert everything to US dollars, but you're still earning in Canadian dollars, unless you have enough rental income to, sustain and so forth. Well, you and I, John, earn a significant amount of our income through one of our active businesses in US dollars. So it gives us a little bit of, we'll call it protection there, that it's like we already have these dollars. Every time we convert a US dollar to a Canadian dollar, we're essentially assuming the risk that we might lose on that transaction, right? Because if it goes up or
Yep.
down, right, we don't know.
Right.
But in this particular case, for us, not only getting that diversification, but also just for those who are thinking about these things, you have to really be able to, like, if let's say the currency swung in one direction or the other, like, how's that going to make you feel? Like, is it worth diversifying out of Canada if you know you're staying in Canada, you feel like you're going to stay in Canada long term, and you're kind of, regardless of how the economy goes? So these are really important things. Now, if I think about this from those who aren't in real estate, or maybe they want less active real estate, right? Like, we're going and buying properties. These happen to be, John, you, I, and Matt have two properties under contract, one in Arizona, one in Florida.
Mhm.
So those are under contract, be closing in the next month. Now, it's not that we're like only looking at single family homes. Like there's some others out there that might say, well, what about, like actually just an investment I don't have to think about? Well, there's investment funds out there. We actually have two on our desks right now that look really good. And we've shared them with a couple of our investors that are out there from the community here. So, there's opportunities for you to take advantage. And the other thing is, like, if you're just index funding it, which is totally fine. There's nothing wrong with doing that. It's not what we do, but if that's what you're doing, are you in Toronto Stock Exchange overall market indexes? Are you in the S&P 500 or US equities? Are you in a global equity fund? The real question you might want to ask yourself from a diversity perspective is, where do you see the general economy going if I'm indexing? And do I want to shift some of that? Do I want all of my, do I want an 80% Canadian sort of portfolio? Or do I want like a 80%, US equity portfolio? If great, go for it. If you're not sure, maybe you want to just make sure it's better diversified across the US and Canada and maybe globally. If we talk to Jim Chong, who was on episode, I'm not sure, but we'll try to look it up and put it in the show notes. But when Jim was on, Jim is a very, very, very staunch advocate for the US. Not only did he buy US property for a number of years, but he also just believes the economy, like Warren Buffett, is going to outdo the Canadian economy and essentially all the others. So he is very much or very heavily into the US market. So who are you? And where are you going to feel most comfortable, I think, is the secret sauce that I want to share with today. And the goal for this episode wasn't to try to convince people that, hey, you should look to the US. It's to say, if you are, why are you looking there? And for us, part of it is personal because, again, like I like this lifestyle opportunity it might provide us later for our families. And the other part is a little bit of diversification at the same point, at the same time. But by no means are we on any sort of, we're not hovering over the eject button here in Ontario or in Canada in general. So just make sure that when you're hearing people and what they're talking about, that you're thinking about your individual needs, your goals, and does it help bring you closer to those goals? Does it, I would hope it's going to bring you closer if you're thinking about it, but then also, does it bring you closer to feeling comfortable and content with how
Right.
you're getting there? Because if it's too hard, you might not do it. You might waste a lot of time. Maybe you hit the eject button
True.
and then never act on it, right? So make sure it's good for you and make sure that you have that team around you that you're surrounding yourself with to help think through some of these questions. Because of course, if we could ask ourselves all the right questions, then we'd all have, all the answers. It's always nice to have somebody from the outside sort of looking in and just asking you those questions to get you thinking about things that maybe just never came up in your own mind yet.
For sure, for sure. And if you were listening to this podcast, other podcasts, and you, let's say you don't have that trusted person right now. It's like I'm on this journey. It feels like I'm by myself. Maybe my business partners aren't ready for this, or maybe my spouse doesn't talk to me about or we don't talk about this type of thing, and I'm not sure where that trust could happen. Is we would love to kind of go down that route with you. Like Kyle said, we have a couple funds on our desk for getting into in this case the United States in some properties. And if you're interested to learn more, we've shared it on our your email newsletter. And if you're not on our email newsletter, you can go on over to CanadianWealthSecrets.com. There's a button at the bottom of that page to sign up for our newsletter. We send out our regular updates each week. But also, you can head on over to CanadianWealthSecrets.com/discovery, hop on a call with us. And then we can just talk about what's some of the right moves that you're making and or you want to make, and where, say, some of your capital lies right now, and maybe there's some choices that we can help you make, but also provide some pathways forward. So head on over to CanadianWealthSecrets.com. There's a few resources there for you to take action on.
Awesome. And friends, we're loving the ratings and reviews we're seeing slowly trickle in. We've got a ever-growing list of listeners, which is helping us stay in the top 200 business podcasts here in Canada. on Apple Podcasts, which is amazing. So keep on listening. And when you listen through an episode, it's telling the algorithm, hey, show this to more people, which is working. That's great. What also helps us is those rating and reviews. So do us a huge solid and essentially look out for your fellow Canadian wealth secret seekers who might be looking for this particular podcast so that they can grow alongside you. So share it however you found it. And friends, until next time, we will see you on the next episode.
Just a reminder, the content you heard here today is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice.
As a reminder, John Orr is a licensed mortgage agent with the Bricks Mortgage license number M23006803. Kyle is a licensed life and accident and sickness insurance agent and VP of corporate wealth management with the PanCorp team, which involves corporate advisors and